Hello friends, imagine sitting down to file your federal income taxes next April, looking at a massive bill on your pensions and your hard-earned IRA withdrawals, and then using one single IRS loophole to wipe that bill completely down to zero. For decades, seniors in this country have been taxed into poverty on the very money they spent a lifetime saving for retirement. But thanks to a massive temporary tax package running through the year 2028, the federal government has authorized a hidden $6,000 senior bonus deduction specifically for Americans aged 65 and older. I want to be perfectly clear right up front. This is not a $6,000 physical stimulus check mailed to your house. It is a massive, legally approved $6,000 federal tax deduction that wipes out a portion of your taxable income, allowing you to keep thousands of dollars of your own money instead of paying it to the IRS. By the time you and I are done talking today, you will know exactly how this new $6,000 senior bonus tax deduction works, the exact modified adjusted gross income limits you must stay under to claim it, and the step-by-step tax math to combine it with your standard senior deduction to completely shield your money. If you stay with me until the very end, I am also going to reveal what I call the Savers Credit Double Dip. This is a perfectly legal strategy where you use this $6,000 deduction to trigger a completely separate federal tax credit, forcing the IRS to actually owe you money. Now, before we look at the math, you need to understand one thing. The rules for retirees change almost every single year, and the government is never going to call you up to explain your options. Everyday folks who subscribe to this channel find out about these changes in time to adjust their income, while the others only find out after their money is already gone for good. Hit that subscribe button right now so you never miss a single dollar you are legally owed. Let us look at how the foundational part of this new law works, which we will call the age 65 plus baseline. Under the temporary tax relief package that runs from 2025 through 2028, the IRS grants an extra $6,000 deduction per eligible senior if you are married and filing a joint return, and both you and your spouse are 65 or older. That deduction doubles to a massive $12,000. To claim this $6,000 rule, you must follow these exact 4 actions in order. First, verify your exact birth date to ensure you hit age 65 before the clock strikes midnight on December 31st, 2026. Second, gather all your 1099-R forms for your pensions and traditional IRAs along with your Social Security statement, Form SSS 1099. Third, write down that $6,000 deduction on your federal return rough draft. Fourth, do not confuse this with the regular extra standard deduction for the elderly. This is a separate additional relief bonus. To see how this works in real life, look at John and Mary. John is 68 and Mary is 66. They file their taxes jointly. To cover their living expenses this year, they withdraw $40,000 from their traditional IRA. Because both John and Mary are over 65, they unlock the full $12,000 double bonus deduction. When they subtract that $12,000 from their $40,000 IRA income, their taxable income instantly drops down to $28,000. Since they are in the 12% tax bracket, shielding that $12,000 from the government saves them exactly $1,440 in cold hard cash this year. Over the 4-year life of this temporary law, running from 2025 through 2028, through 2028, John and Mary will save a total of $5,760 in federal taxes. Now, your personal situation changes this math. For instance, if a married couple consists of one spouse who is 67 years old and one spouse who is 62 years old, they only get one single $6,000 bonus deduction on their joint return. They do not get the $12,000 multiplier because the younger spouse has not hit the legal age trigger yet. Younger spouses on a joint return do not individually trigger the bonus, but before you go out and claim the full amount, you must pass the IRS's strict income test, or the deduction vanishes right before your eyes. This brings us to the second major rule you must watch out for, which is the modified adjusted gross income phase-out trap. The government explicitly targets this tax relief to middle-class seniors. Wealthy retirees are locked out. If your modified adjusted gross income, which the IRS calls your MAGI, is under $75,000 as a single filer, or under $150,000 as a married couple filing jointly, you get the full $6,000 or $12,000 deduction. But if your income goes even one single dollar above these strict limits, your senior bonus begins to phase out rapidly, eventually hitting zero. To keep your bonus safe from this cliff, you need to take these 4 specific steps before the end of the calendar year. First, calculate your baseline modified adjusted gross income by adding up your W-2 wages, your traditional IRA withdrawals, your taxable pensions, and exactly 50% of your Social Security benefits. Second, check your total against the limits, $75,000 if you are single or $150,000 if you are married filing jointly. Third, if you find yourself sitting near the edge of that cliff in November or December, completely stop pulling money out of your pre-tax IRA. Fourth, delay any further retirement withdrawals until January 1st of the next year to keep your income safely below the phase-out limit. Let us look at Susan to see why this matters. Susan is 69 years old and files as a single person. Between her pension and a small part-time job, her modified adjusted gross income sits at $73,000. In December, she decides she wants to take an extra $5,000 out of her traditional IRA to pay for a family vacation. If Susan takes that $5,000, her income hits $78,000. She crosses the $75,000 cliff. Suddenly, her $6,000 tax reward begins to phase out, costing her roughly $800 in lost tax deductions. By simply delaying that $5,000 IRA withdrawal until January of the next calendar year, her modified adjusted gross income for the current tax year stays at $73,000, and she keeps her entire $6,000 deduction intact. Your filing situation can make this trap even more dangerous. If you are married but choose to file separately, the IRS severely penalizes you. For married individuals filing separately, the phase-out limit drops from $150,000 all the way down to just $75,000, making it incredibly easy to cross the line and lose the benefit entirely. Once you confirm your income is safe from the phase-out trap, you have to stack this new bonus on top of the old rules to create a total tax shield. Let us talk about exactly how you build that shield. Most people do not realize that seniors over the age of 60 are already given a head start by the IRS. Under the traditional system, you receive an extra standard deduction that gets added directly to the normal standard deduction everyone else gets. The secret to unlocking massive tax savings is mathematically stacking 3 entirely separate layers of protection together into one single giant shield. You take the baseline standard deduction, you stack the extra $65 plus standard deduction on top of it, and then you drop the new $6,000 senior bonus deduction right on top of both of them. To map out your own tax-free zone, you must walk through these 4 steps in order. First, start with the baseline federal standard deduction, which for a single filler is roughly $15,000. Second, add the extra standard deduction for taxpayers aged 65 and older, which adds roughly $1,950 to your line for a single person. Third, add the new temporary $6,000 senior bonus deduction we just went over. Fourth, combine all 3 of those numbers together to establish your absolute total tax-free zone. Look at how this protects a gentleman named David, who is 67 years old and single. David lives on a $20,000 annual pension and a $15,000 Social Security check, giving him a total gross income of $35,000. When David sits down to map out his return, he stacks the base deduction of roughly $15,000, the $65 plus extra deduction of roughly $1,950, and the new $6,000 bonus deduction. That simple math creates a total tax shield of roughly $22,950. Because the IRS already leaves a large portion of Social Security checks completely untaxed, David's remaining taxable income falls entirely underneath his $22,950 shield. His final federal income tax bill is exactly $0.00. Depending on your personal health situation, your shield can grow even larger. If a senior is legally blind, the IRS allows them to add yet another extra standard deduction on top of the age 65 reward. This means you can actually stack 4 separate layers of legal protection against the IRS on a single return, pushing your tax-free zone even higher. This math is incredibly powerful, but if you go out and hire a private certified public accountant to map it out for you, they can easily charge you $400 just to file the paperwork, destroying a massive chunk of your savings. Luckily, the federal government has a completely free bypass system that most seniors never use. You do not have to pay big corporations like TurboTax or H&R Block a single dime to claim this $6,000 reward. The IRS has fully rolled out a program called Direct File for simple tax returns, and they fund a program called Volunteer Income Tax Assistance, or VITA, which places IRS-certified volunteers right in your neighborhood to do all this complicated math for you at no cost. This free service is open to low to moderate income seniors, generally targeting anyone making under $64,000 a year. To get your return prepared completely for free, you need to execute these 4 steps. First, go to the official website at irs.gov/VITA to use their locator tool and find the nearest clinic, which is usually held right down the street at your local public library or neighborhood senior center. Second, call the number listed to make an appointment for late February or March. Third, pack your bags with your photo identification card, your physical Social Security card, your W-2 forms, every 1099 form you received, and a blank check from your bank account so they can set up direct deposit for your refund. Fourth, when you sit down at the table, look the volunteer in the eye and say these exact words: I need to ensure the new 2026 Senior Bonus Deduction is applied to my Form 1040. S.R. Consider a lady named Linda who is 72 years old. For years, Linda went to a commercial storefront tax preparer at a local strip mall, and they charged her $350 every spring just to type her basic pension forms into a computer. Linda breaks the cycle by making an appointment at the VITA clinic inside her local library. The certified volunteer sits down with her, fills out her forms, applies the $6,000 deduction, and hands her the completed return for exactly $0. Linda keeps her maximum tax refund, and she leaves that $350 preparation fee sitting safely in her own checking account. Over 5 years of retirement, utilizing the VITA system saves Linda $1,750 in sheer preparation fees alone. If there is not a VITA clinic close to your home, there's an alternative situation you can look for. The AARP runs a parallel program called Tax-Aide. The volunteers in the Tax-Aide program are specifically trained in senior-focused tax laws, just like this $6,000 bonus, and their program is completely free for any taxpayer aged 50 or older, regardless of how much money you make. Now, securing your federal tax return is a massive victory. But lowering your federal income actually triggers a hidden domino effect at the state level that can save you even more. Let us look at how that state-level domino effect actually works. Many people do not realize that your federal tax return acts as the foundation for your state taxes. If you live in one of the 41 states that collects a state income tax, your local government often provides massive property tax freezes or senior pension exemptions. The catch is that you are only allowed to claim those state perks if your federal adjusted gross income stays below a very strict cutoff number. By using the $6,000 federal senior bonus deduction to aggressively crush your federal income, you accidentally drop yourself below those local limits, qualifying you for massive state-level rewards you used to be blocked from getting. To make this domino effect work for your household, you must take these 4 steps. First, look up your specific state's rules for their senior pension exemptions, or what is known as a circuit breaker property tax credit. Second, file your federal tax return first, applying the $6,000 senior bonus deduction to drive your adjusted gross income down as low as legally possible. Third, carry that newly lowered federal income figure directly over to your state tax application forms. Fourth, apply for the state-level senior exemptions that you previously made too much money to qualify for. To see this in action, look at Robert, who is 70 years old and lives in Illinois. Robert has a total annual retirement income of $58,000. He wanted to apply for the Illinois Senior Citizens Real Estate Tax Deferral Program to get help with his real estate bills, but that specific state program requires an income under $55,000 to qualify. Under the old tax rules, Robert's $58,000 income meant his application was flatly denied, forcing him to pay his entire $4,000 property tax bill out of his own pocket. But in 2026, Robert uses the $6,000 federal senior bonus deduction. That drops his federal adjusted gross income down to $52,000. He takes that new $52,000 figure and writes it on his Illinois state application. Because $52,000 is safely under the $55,000 state cliff, Illinois approves his application. Robert saves $1,440 on his federal income taxes, plus he secures $4,000 in state property tax relief. The $6,000 deduction literally saved him $5,440 across the board. Your physical location dictates whether this specific trick applies to you. If you live in one of the 9 states like Florida, Texas, or Nevada that has no state income tax at all, this specific state income domino effect will not provide extra local savings. However, the raw federal tax savings still apply to your return no matter which of the 50 states you call home. This brings us to the final strategy, which is the single most lucrative IRS trick available to seniors. It allows you to take your newly lowered income and turn it into an actual cash credit. This is the Savers Credit Double Dip, which officially uses Form 8080, the Retirement Savings Contributions Credit. The Savers Credit is a non-refundable tax credit that forces the IRS to pay you up to 50% of the first $2,000 you save into a retirement account. The problem is that the income limits to get that 50% match are brutally low, cutting off at roughly $38,250 for a single person. But by applying the $6,000 senior bonus deduction first, you can artificially crush your adjusted gross income, slide right under that strict limit, and double dip the system. This trick is open to low to moderate income seniors who are still working a part-time job and contributing to an IRA. To execute the double dip, follow these 4 actions. First, calculate your gross earnings from your part-time job and your retirement pensions. Second, apply the $6,000 senior bonus deduction to lower your adjusted gross income line. Third, if your new income figure falls below the $38,250 limit, immediately contribute $2,000 of your part-time earnings into a traditional or Roth IRA before tax day arrives. Fourth, file IRS Form 8880, along with your regular tax return to claim your 50% cash credit. Look at Mary, who is 66 years old and single. Mary works part-time as a consultant, bringing in a gross income of $42,000. Because the 50% tier of the Savers Credit cuts off right around $38,200, and $52,000 income normally disqualifies her completely, leaving her with $0 from the credit. But in 2026, Mary applies the $6,000 senior bonus deduction to her return. Her income instantly drops down to $36,000. Because $36,000 is safely under the $38,250 threshold, she puts $2,000 of her earnings into a Roth IRA. The IRS rewards her with that 50% credit, meaning $2,000 multiplied by 50% gives her a $1,000 direct tax credit. The $6,000 senior deduction did not just save her $720 in raw income tax, it triggered a separate $1,000 credit on top of it. Mary successfully double-dipped the IRS for a total of $1,720. You must watch out for the strict definition of income for this specific credit. To contribute to an IRA and trigger the Savers Credit, you must have what the IRS calls earned income, such as W-2 wages or net self-employment earnings. Pension payouts, traditional IRA withdrawals, and Social Security checks do not count as earned income for this specific trick, so you must have some part-time work to make the double dip work. Let us summarize everything we have uncovered today so you can protect your savings. First, we looked at the temporary senior bonus deduction, which gives you $6,000 of protection if you are single and $12,000 if you are a married couple where both spouses are age 65 or older. Second, we exposed the phase-out trap, showing how you must keep your modified adjusted gross income under $75,000 for singles or $150,000 for couples to keep the benefit from vanishing. Third, we learned how to stack the baseline deduction, the extra 65 plus deduction, and this new bonus into a massive tax shield. Fourth, we discovered how to bypass expensive corporate preparers by using free IRS direct file or a local VITA clinic. Fifth, we walked through the state-level domino effect, showing how a lower federal income can unlock thousands in property tax relief in states like Illinois. Finally, we unpacked the Savers Credit Double Dip on Form 8880, showing how working part-time can turn a tax deduction into a $1,000 direct cash credit. You survived the workforce and paid taxes your entire life. This $6,000 deduction is the government's temporary legal way of finally leaving your retirement savings alone, but you must take the initiative to claim it before the 2028 expiration date.